Welcome back to the Daily Crypto Deep Dive. Today we're doing something that every single investor needs to hear, because this one topic determines more long-term wealth in crypto than almost anything else. It's the battle between yield and growth, between the comfort of steady staking rewards and the excitement of coins that explode in price. And what makes this deep dive especially relevant is that investors are getting pulled in two opposite directions right now. On one hand, you've got coins offering 10, 15, even 20% annual staking rewards. And on the other hand, you've got ecosystems like Solana and Avalanche offering lower yield, but delivering price charts that don't even look real half the time. So today we're going to break it all down, we're going to compare real numbers, we're going to look at analyst projections, and we're going to see whether the safest choice is actually costing people far more than they realize. And remember, before we dive in properly, make sure you're following the show. If you're listening on Spotify or Apple Podcasts, hit the follow button so you don't miss any of these deep dives. And if you're enjoying the content, give it a 5-star rating. It genuinely helps push the show out to more people. Now let's start with the core problem that investors face, even if they don't realize they're facing it. When a coin offers a high staking reward, something like Polkadot at 15% or Cosmos at 17%, it feels like free money. It feels safe, predictable, and almost like you're being rewarded just for showing up. And if you stake long enough, you start to mentally rely on that income, which creates a psychological attachment to the coin, even if its actual price performance is going nowhere. Polkadot is a perfect example. After launching as one of the highest potential ecosystems in the market, DOT spent nearly 2 years bleeding in price, drifting from the high 40s all the way down to the low 4s. But because the staking rewards stayed high, a massive number of investors held onto it, believing the yield alone justified the position. Meanwhile, Solana, which offers a fraction of DOT's APY, went from near collapse to one of the best performing assets of the decade. And that's the tension we're exploring today. Because when you zoom out and run the numbers over 10 years instead of 12 months, the truth is brutal. No amount of yield can compete with true exponential growth. If you stake a coin at 15% for a decade, you roughly quadruple your position. But if a coin 20x's, 30x's, or 50x's in the same period, yield doesn't even enter the conversation. That's the heart of the problem. People stake high-yield coins because they feel safe. People buy high performers because they feel hopeful, and the real art is working out which coins fall into which category, and when to hold them. So let's go deeper, starting with Polkadot, because it's the perfect coin for explaining how this works. DOT is one of the highest-yielding major assets in the market. Depending on validator choice, staking rewards usually sit between 14 and 17%. That's excellent income, far higher than Ethereum, Solana, or even Chainlink. And on paper, that makes DOT attractive. But the reason Polkadot can offer those yields is also the reason the price has struggled, and that's inflation. DOT prints new tokens constantly to support network security. And although Polkadot 2.0 is aiming to tighten monetary expansion and become far more efficient with its parachain model, you can't escape the truth. Inflation eats into price performance unless demand is massive. And this is where analyst opinions become fascinating. Several institutional reports this year have said the same thing. Polkadot is transitioning from a yield-first coin into a growth potential coin. The parachain auctions are gone, the network is becoming more modular, and the new tech stack looks like it could reposition DOT as a serious competitor in the cross-chain interoperability market. One note even said, quote, "Polkadot's yield will make sense only if price appreciation returns. Until then, the APY is masking a multi-year underperformance." That's a strong line, and it reflects what many investors are waking up to. But the important part is this. Polkadot gives us the blueprint for understanding every other coin in this debate. When you're earning yield, you need price stability or price growth to make that yield meaningful. If the coin drops 50% while you earn 15%, you've gone backwards. And many investors don't realize that until it's too late. Cosmos has suffered the same issue. Cardano too. Phantom, at one point, was paying almost 20%. But price wiped out the yield multiple times over. Now let's flip to the other side of the spectrum, the growth monsters. Solana barely yields anything meaningful. Even if you stake it, by the time you subtract inflation, network fees, and validator commission, The real yield can be as low as 1%. That's basically zero. And yet, Solana has been one of the best investments in crypto history, minting new millionaires every cycle. How? Because price growth destroys yield mathematically. If a coin goes up 20-fold, you don't care about the 1% you made staking. In fact, in many cycles, unstaked SOL outperformed staked SOL, simply because people who kept it liquid could rotate into higher-performing opportunities. Avalanche follows a similar story. Low yield, high volatility, high upside. Ethereum, as always, sits in the middle. It yields modestly, but not enough to be called a yield coin. And yet it grows consistently enough that institutions trust it as the safest long-term play. What's interesting is that analysts often label Ethereum the balanced asset. Not quite a yield generator like Polkadot, not quite a rocket ship like Solana, but the strongest combination of both. This is why trillions may eventually flow into Ethereum-based ETFs worldwide. It's the only asset institutions can scale into without breaking the market. Now this brings us to the biggest insight of today's deep dive. Yield is stability. Growth is opportunity. But the winner depends entirely on what your portfolio needs. If you need income, yield makes sense. If you need life-changing growth, you have to accept volatility. But the third path, the hybrid path, is where most analysts say the real wealth is built. Hybrid coins include Ethereum, Chainlink, BNB, and possibly Polkadot 2.0 if its ecosystem reaches escape velocity again. These are coins that yield enough to justify holding them, while also having the potential to grow significantly in price. Chainlink is the example that surprised investors the most. Link does not have high staking rewards, but it has real revenue, real adoption, and real institutional integration. And that combination has caused its price to surge again, far outpacing high-yield coins that looked attractive on paper. One institutional analyst recently made a fascinating prediction. They said that by 2030, the crypto market will split into three classes: yield layer assets, compute layer assets, and settlement layer assets. Yield layer assets will generate income but may stagnate in price. Compute layer assets, like Solana, will see the biggest growth, and settlement layer assets, like Ethereum, will sit in the middle but attract the most institutional capital. Under that model, Polkadot sits between a yield layer and a compute layer, which gives it one of the most interesting risk-to-reward profiles in the market if developers continue to build aggressively. But to decide whether yield or growth is the smarter play, we need to go deeper into how money actually behaves in this market. Because most investors assume people pick coins based on fundamentals, or utility, or narratives, or whatever the influencer of the week is talking about. But that's not true. Capital moves according to return expectations, and those expectations are shaped by something called the risk premium. Before we break all this down, we are going to take a quick 30-second break. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
If a coin offers 15% yield, the market interprets that yield as the risk premium. And if the premium is that high, the market is signaling there's risk built in somewhere. It might be inflation. It might be a weak ecosystem. It might be developer flight. But it's a warning that the yield isn't free. It compensates for structural weakness. This is why very few high-yield coins become long-cycle winners. It's why the DeFi yield farms blew up. It's why Anchor Protocol collapsed even though it was paying 20%. It's why many Layer 1 staking models eventually reduce their inflation. Markets are efficient over the long term. If the yield is too high, it usually means something in the underlying economics isn't sustainable. Meanwhile, growth coins tend to have lower yield because they don't need to offer one. Demand itself is the incentive. Solana doesn't need to bribe people to stay. Ethereum doesn't need to inflate the token heavily to reward stakers. Chainlink doesn't need to wave APY numbers in your face to keep developers integrated. The demand for the network itself is the reward. And if there's one thing we've learned in every crypto cycle, it's that demand beats emissions every single time. But this doesn't mean yield is pointless. In fact, yield can be extraordinarily powerful when paired with price appreciation. This is where Polkadot becomes interesting again. If Polkadot 2.0 succeeds, DOT could produce the rare combination investors dream of: strong growth plus strong yield. And when those two forces combine, the compounding can be insane. Let's imagine DOT hits $50 again over the next cycle. If an investor is staking with a 15% yield over that time, their nominal balance could double after 5 years, and double again after 10. And if the price holds or grows further, you get a portfolio that grows both from capital appreciation and compounding income. That's the holy grail of crypto investing. But it's incredibly rare. The next thing we need to examine is compounding mathematics, because most investors massively underestimate what compounding can do over a decade. If you stake at 10% for 10 years, you don't make 100%, you make 159%. If you stake at 15%, you make 300%. But again, if the price drops by half, all of that compounding disappears. And this is what analysts warn about constantly. High yield is only powerful when combined with either stable or increasing prices. Otherwise, it's just a distraction. Now here's where things get even more interesting. When you talk to institutional investors, the people running pension funds, endowments, private wealth desks, they don't look at coins the way retail investors do. Retail investors ask, what will this coin be worth next year? Institutions ask, what will the cash flows look like over 15 years? And this is why Ethereum is still the #1 institutional favorite. ETH generates real yield, not because it prints tokens, but because it earns fees. Every transaction on the network contributes to the security budget, which flows to stakers. That is real yield, backed by economic activity. Polkadot's yield is also real in the sense that it secures the network, but it's inflationary. Solana's yield is partially inflationary. Partially fee-based Cosmos is mostly inflationary. Avalanche has a hybrid approach. But Ethereum is the closest thing crypto has to an economy that pays you for securing it without relying heavily on token emissions. This makes Ethereum one of the most sustainable long-term assets in the market, even if the price doesn't move as violently as Solana or Avalanche. But here's the twist. Analysts believe that Solana may eventually follow a similar path. As volume grows, fees increase, and the network matures, Sol's effective staking yield will gradually shift from inflation-based to fee-based. When that happens, Solana could become what Ethereum is today, a low-yield, high-value, high-demand settlement and compute layer with sustainable economics. And if that plays out, Solana would enter its next evolutionary phase, one where price appreciation slows but yield becomes more meaningful. This is exactly what Polkadot wants to achieve with its 2.0 upgrade. A shift towards efficiency, modularity, and fee-based economics rather than inflation-based economics. If DOT can reduce inflation, increase demand, and grow its ecosystem again, it could become one of the strongest hybrid assets in the market. And that's why analysts are more bullish on DOT today than they were a year ago. Not because of the price performance, but because of the structural upgrades underway. Now let's talk about investor behavior, because this is where the biggest mistakes are made. Most retail investors chase yield because it feels like guaranteed money. When they see 15%, they imagine a future where their balance grows effortlessly. But what they forget is that the value of their balance depends entirely on price, and price depends entirely on demand. If demand doesn't grow, yield becomes irrelevant. On the flip side, many retail investors chase growth coins without understanding their risk profile. They buy Solana at the top and panic sell at the bottom. They load up on Avalanche during a hype cycle and exit during the first correction. They chase Chainlink when it goes parabolic and dump it during consolidation. In both cases, the mistake comes from misunderstanding how cycles and liquidity behave. This is where analysts often say, yield is for maturity, growth is for conviction. If you're early in your investing journey and want to build wealth, growth coins historically outperform yield coins by a huge margin. But if you're later in your journey, seeking stability or income, yield begins to matter more. And crypto, maybe more than any other market, offers both options. The key is knowing which one your portfolio needs at the current stage of your life. Now let's get into the 5-year outlook, because this is where things get genuinely exciting. According to 3 major institutional research desks, Fidelity Digital Assets, Pantera Capital, and Franklin Templeton, the crypto market of the late 2020s will be dominated by yield-bearing assets, tokenized treasuries, and infrastructure chains. That means chains like Ethereum will continue to attract long-term institutional capital. Solana and Avalanche will attract the high-growth capital, and coins like Polkadot, Cosmos, and Cardano will need to evolve dramatically if they want to stay relevant as ecosystems. Fidelity made a fascinating prediction recently. They said that by 2030, the average crypto investor will hold 40% in Bitcoin and Ethereum, 40% in high-growth altcoins, and 20% in yield assets. That means yield has a place, but it's not the core. And if that forecast is right, high-yield coins will need to prove they can deliver more than APY. They'll need to deliver innovation and adoption. But some analysts disagree. Galaxy Digital argues that yield will dominate the next cycle because institutions crave steady cash flow. They believe tokenized real-world assets, US treasuries, corporate bonds, on-chain debt instruments will become the backbone of crypto income. And if that happens, yield coins might be competing not with each other, but with tokenized versions of traditional finance. In that world, Polkadot and Cosmos would be competing with tokenized bond markets, and the yield equation shifts dramatically. So which argument is more convincing? The truth is, both have weight. The growth-focused view makes sense if crypto adoption continues to accelerate and new capital flows in aggressively. The yield-focused view makes sense if institutional investors prioritize steady returns over volatility. And the hybrid approach, once again, sits in the middle as the most balanced framework for most portfolios. To wrap this up, the real mistake most people make is thinking yield and growth are enemies. They're not. They're tools. And the best portfolios are the ones that use both, depending on the stage of the market and the stage of the investor's life. Crypto gives you access to growth coins that can change your financial trajectory, and yield coins that can stabilize that trajectory. The trick is knowing when each one matters. If you enjoyed today's deep dive, make sure you follow the show, hit that 5-star rating, and share the episode with anyone who needs to understand this yield versus growth debate properly. We'll be back tomorrow with more, and as always, we'll see you at the top.